Hey guys, today I wanted to show you this pretty cool observation for short sellers. As you can see, there's a lot of red on this pattern that I found. So if you don't know what to choose between a long and a short position in the stock market, but you keep an Excel sheet like this, it's really going to help you out. Just so you know, let me go over real quick just one of these line items, so you know how is it that I track these. So for example, the first one is DTSS on 214.24. 214.24 DTSS. So pretty much what I'm showing, it's how much did it spike pre-market. So from the previous day close to the highest point pre-market, that's your gap up. And then from the highest point pre-market to the opening price, I'm going to move to the 5-minute so it can be easier to see. From the pre-market high to the opening price, that's your pre-market decline. I call that the pre-market decline. And then from the opening price going upward, that's going to be your spike. And then from the opening price going downward, that's going to be your spike down. Okay? So as you can see here for this particular pattern that I found, most of them, if you were to short everything that is extended over 100%, extended, once again, it means from the prior day closing to the opening price. Anything that is extended, in this case, it'll be 606%. Okay. So anything that is extended over 100%, if you short this, if you want to short covering in short market, if you want to short it in the long term, you will turn profitable. Practicing keeping your stats and sticking to your plan will show you how to short sell in the long term. So like I said, there's always important to just keep one or two, at most 3 patterns that you should work with, and don't go beyond that, because then you're going to get mixed up. Okay, so this one is very, very straightforward. All of this data here is for 2004. Pretty much what it shows is that after anything that is extended over 100, this right here, this is your closing percent. If it's red, that means it ended downward like this, right? It started here, it closed over here. So if you can see here on the blue box right here, it ended minus 31%. So all of these, anything from extended from here and up, if you look at the sum, it's 890%. Of course, it's not all nice and dandy. You also have to account for the spike. Now, what I like to do, I'm going to move this over to a new sheet just so I can focus on anything that gapped up over 100. What I like to do is cap my losses, because you will have losses. Okay, spike. Let me look at anything that spiked up. Like this. Usually I like to cap my losses at 50% or 70%. In this case, it doesn't seem like a bad idea to stop your losses at 50. So, for example, let's say that all of these losses, all of these are going to be 50% loss. So you're going to count 50 times, that's 18, okay? This is going to equal 50 times 18. 18 times, you're going to lose 50%, okay? And then the rest of the times, if you're a short seller, you are going to get a total of 1,750. That is a big return, okay? 1,750% return. Minus 1,750. So if you're a short seller, this is going to be your return. And these are going to be your losses. Because remember, you just never know how far it can go up, and you never, ever, ever want to be completely exposed with no stop loss. Short sellers, if you're a long trader, you should know that a long, the worst that could happen is that the stock goes to zero. Okay, but if you're a short seller and the stock keeps going up and up, there is no stopping. There's no limit. So you must always have a stop. In this case, 50% doesn't look so bad. That means that all of these times right here, you're going to cap your losses at 50. So instead of 52, you're going to cap it at 50. You're not going to get, these massive losses. You're going to cap them at 50. So once again, that's going to be 50 times 18 times. 50 times 18, 900, it's going to be your loss. However, your wins, once again, 17 over here, the sum, 1751 for short sellers. So then the difference is going to be this one plus this one, 850. So you're going to make about an 850% return. I usually subtract about 1%, maybe 2% per item due to fees, transactional fees, borrow fees, and then just for the liquidity, because every time you enter a position, it does change your you do have an impact on the price. So even if you subtract like 1% per item, that's 75. Okay, that's 75 transactions. So say you also had 75 in losses from fees and borrowing fees and borrowing fees. You're going to add another 75 in losses. You're still going to be 700% return. Okay, so this is a really cool pattern. The cool thing about this also is that it seems to work. I have data for 2020 from all the way from 2020, and it seems that it works every single year. So in bear markets, in bull markets, the only downside is that in a bear market, you won't see as many. Okay, yeah, like I think in 2020 or 2021, there was only like 20 in the entire year. So there's not going to be a lot of entries, but in 2022 it picked up, 2023 picked up, 2024 is out of control. I mean, we're already in June. This is data for January to May, and we already saw 75. So there's probably another 75 for what's left of the year. Okay, so this one is pretty basic, pretty standard. And what I like about this is that, like I said, I don't want to think when I'm trading. I want to do the thinking outside of trading, because when you do the thinking outside of trading, once the trading starts, you don't have to be dealing with all those emotional roller coasters and you start shaking and you can't think. You start making mistakes. I want to do the thinking outside, so then when the market opens, I know exactly what I'm going to do, if I'm going to do it, and how I'm going to do it. And I don't want to do any decision making. The decision making is already done for you. That is pretty much the only requirement. The pre-market volume has to be over 1 million. It could be any float, and it could be any market cap. It could be any price. See, this one's so cool because it's so easy. Any price, any market cap, any pre-market float, any pre-market volume, doesn't matter how much it moved the prior day, the previous day changed. It doesn't matter. The gap up doesn't matter. All that matters is that it's extended at least over 100%. And you short those over and over and over. It's like a casino. You don't care if you make money or you lose. What you know is that over the long run, you will turn out profitable. Okay, so that one was a pretty cool. This one was a pretty cool observation. Yeah. So if you guys have any comments, questions, or want to see me try some other patterns that you might have, let me know down below. Thank you.